Bloom Energy just lost roughly $10 billion of market value in one trading day. But here is the strange part. The power shortage it is solving did not get 15% smaller. Oracle still needs electricity. AI data centers still need to open. And Bloom can put reliable power beside the servers in weeks instead of waiting years for the grid. So, is this sell-off a warning? Or the first real opening investors have had in one of AI's most important infrastructure stories? By the end of this video, I'll give you 3 numbers that can answer that question. For the last few years, investors chased the obvious AI bottlenecks: GPUs, memory, and advanced packaging. Now, the bottleneck is moving into the wall socket. U.S. data centers consumed about 4.4% of the country's electricity in 2023. The Department of Energy says that share could reach between 6.7 and 12% by 2028. That is not a gradual increase. It is a wave of enormous power demand arriving in very specific places, and the customers want it now. A developer can build a data center faster than utilities can build the generation, substations, and transmission needed to serve it. The scarce asset in AI is becoming time to power. This is the key to understanding Bloom. The company is not simply selling electricity. It is selling the years a customer may otherwise spend waiting for electricity. Bloom says its first system for Oracle became fully operational in just 55 days, more than a month ahead of the expected 90-day schedule. 55 days. For an AI campus filled with depreciating GPUs, opening even 1 year earlier can mean hundreds of millions of dollars of compute revenue pulled forward. Bloom is competing against the cost of delay, and that can be far more valuable than saving a fraction of a cent on a kilowatt hour. So how does the energy server work? Fuel enters one side, air enters the other. Inside a stack of ceramic cells, an electrochemical reaction moves electrons through a circuit and produces continuous electricity. No combustion step, no giant turbine. And because the boxes are modular, a customer can add power as the data center campus grows. Most systems today run on natural gas, so this is not zero-carbon magic. The practical advantage is speed, dense, always-on generation placed directly beside the load, without waiting for a new long-distance transmission line. That is the product. Now look at the scale. Oracle has contracted an initial 1.2 gigawatts of Bloom capacity for projects in the United States. The master agreement can support up to 2.8 gigawatts. That is not a science project. It is utility-scale demand being delivered as modular on-site power. And it changes the investment debate. Investors no longer have to ask whether a hyperscaler would trust Bloom with mission-critical AI infrastructure. Oracle already has. The question now is whether Bloom can manufacture, install, and service these systems fast enough to meet demand. That is a much better problem for a growth company to have. Then Brookfield attacked the next constraint: capital. In June, Brookfield expanded its framework to finance Bloom-powered AI infrastructure from $5 billion to $25 billion. Be precise here. That is financing capacity, not $25 billion of Bloom revenue. But it matters because a customer can have land, chips, and demand, and still struggle to finance the power system quickly enough. Brookfield brings capital and development experience. Bloom brings the power platform. Together, they can package electrons, infrastructure, and financing from the start. That can turn more customer interest into constructed projects and make Bloom easier to choose. This bull case would be far less interesting if the financials were still moving sideways. They are not. First quarter revenue reached $751 million, up 130% from a year earlier. Product revenue grew 208%. GAAP gross margin reached 30%. Operating income was positive $72 million, and operating cash flow was positive $74 million. Management raised full-year revenue guidance to between $3.4 and $3.8 billion. The midpoint implies roughly 80% growth. That is the inflection investors have waited years to see. Demand filling the factory, margins improving, and growth beginning to produce cash. Even service gross margin jumped from roughly 1% to 13% year over year. More installed systems can create a larger, more profitable service base. That is how a hardware sale can become a compounding platform. Here is the part one thing investors may still be underestimating. Bloom does not need to replace the electric grid. It only needs to become the standard shortcut when the grid is too slow. If on-site power is designed into an AI campus alongside compute, cooling, and networking, Bloom moves from emergency workaround to a standard piece of infrastructure. Every successful deployment can make the next customer easier to win. Oracle proves scale. Brookfield can remove financing friction. Faster openings create economic value for the data center owner. That is a powerful flywheel, and it can extend beyond AI into semiconductor fabs, hospitals, and factories that cannot afford unreliable power. Now for the part the bulls cannot ignore. Even after the sell-off, Bloom is worth roughly $59 billion. Against the midpoint of current 2026 revenue guidance, that is about 16 times sales. That price still assumes exceptional execution. Customer concentration is high. Most systems use natural gas. Installation economics must improve. And a recent short report questioned Bloom's accounting, backlog, and scandium supply. Bloom categorically rejected the accounting claims and said its scandium supply can support current demand and major future production. The argument will not be settled by louder opinions. It will be settled by reported numbers. And Bloom reports second quarter results on July 28th. So here are the three numbers I would use. Number 1, deployment pace. Oracle's 1.2 gigawatts must convert into installations and revenue on schedule. Number 2, GAAP gross margin. 30% is the line to defend. Holding or improving it would show that scale is strengthening the business, not just making it larger. Number 3, operating cash flow. Positive cash generation needs to become repeatable while Bloom expands production. If those three numbers hold, this drawdown could become a staged entry opportunity. Start small, keep dry powder, and let execution earn a larger position. If deployments slip, margins fall sharply, or cash burn returns, the valuation can compress much further. That is the trade. Extraordinary growth, but no room for ordinary execution. My bullish view is simple. AI has created a race to secure power. Bloom has commercial proof that it can deliver that power quickly at scale beside the machines that need it. The stock is expensive. The controversy is real, but the underlying business has never looked more relevant. Bloom does not have to win the entire energy market. It only has to own the most valuable months and years between an AI campus being built and the grid finally arriving. If you enjoyed this deep dive, leave a like and subscribe to Risk on Capital. We break down the companies and technologies shaping the next decade of investing.